We're going to talk about how to reduce risk. This is aimed at passive investors that are going to passively invest. So when you look at passive investing, though, it's not passive. You need to look at this like you're buying a property, buying a deal. You need to be being very careful. So a little bit of housekeeping first. Disclaimer, I'm not an attorney, a CPA, a financial advisor, so I'm not giving tax, financial, or legal advice. This is for education purposes only. When you invest in real estate, it has risk. Make sure you understand the risk profile before investing. I'm not guaranteeing investment returns or outcomes in real estate investing based on the things I'm going to share with you. And this document contains information from sources I believe to be reliable, but I can't guarantee their veracity. And if I'm using numbers or financial projections in the document, they may be based on assumptions, hypotheticals, or estimates. And nothing in this document has been reviewed or approved by the Securities Exchange Commission. We're not going to be showing you any kind of a deal or offering any securities today. Okay, so let's talk about me and my background. This is me and my wife. I'm a general partner in 6 deals right now, about 1,200 units. I have a 20-year background in real estate. I started out on the transactional side, doing mortgages, about $500 million worth of mortgages over 20 years. And as a real estate broker, so I'm really good at analyzing numbers and analyzing deals from that background. My wife and I are also passive investments in apartments, self-storage, and oil and gas. I'm a big believer in doing both. So you shouldn't decide if you're going to be an active investor or a passive investor. You should really be a passive investor. But if you decide to be active, you should invest in other people's deals. And that way, if you make mistakes or screw up, you don't lose all your money because you've got money placed with other people. So I'm a big believer in doing both. So that's a little bit about my background. I'm a big fan of Warren Buffett, and I'm a big fan of his 2 rules of investing. And a lot of people, when I bring up Warren Buffett, they're like, well, he's not a real estate guy. He's a stock market guy. So let's talk about that for a second. Buffett does not invest in the stock market the way you and me invest in the stock market. We go on E-Trade or whatever and buy 100 shares of Apple. Warren Buffett goes and buys companies, and he buys so much of the shares in the company that he has a controlling interest. He can fire the CEO, he can change the board, he can do anything he wants because he buys large shares. So he buys companies he thinks are undervalued, and he turns them around and makes them more valuable, and the share prices go up. It's very similar to what we do in commercial real estate. We're buying stuff that we feel is undervalued. So you want to invest like Warren Buffett. Rule number 1, never lose money. That's his rule. And I believe in real estate, if you can follow that rule and really try to never lose money, you're going to kill it. Does it mean you're never going to lose money in real estate? No. But if that's your goal, you're going to be way, way, way ahead of everyone that is trying to get rich quick in real estate, because real estate is not a get rich quick business. It takes time. It takes blood, sweat, and tears. Rule number 2 is real simple. Never forget rule number 1. So stay focused on rule number 1. Think like Buffett, focus on not losing money. So I'm going to introduce the method that I use to quickly evaluate deals. And I call it the DEAL method. And DEAL is an acronym, DEAL. So it's very easy to remember. So I use this method when I'm looking at deals. So the first thing I look at in a deal is I look at the debt structure. And if you want to basically increase your knowledge about deals or financial education, the first place you should start is understanding debt structures and different structures on loans. And the reason I say that is your biggest risk of losing money on a deal is a foreclosure. So what happens in a foreclosure is when the debt structure fails and the lender takes the property back. So if that is going to be your biggest threat, you need to learn deal structures. So we look at the loan type first. Is it a fixed rate? That's a non-negotiable for me. And we look at the initial DSCR, which is the debt service coverage ratio. And this tells us after we put the debt on a deal, is it cash flowing right now, day 1? So that's going to be what I look at first. That's the first thing I look at. We'll talk about that in detail here in a moment. The second thing I look at is E, stands for the experience and expertise of the GP team. Nothing is a substitute for expertise and experience. So we're going to talk a little bit about what I look for in that. I look for the GP team. I look at their track record. You need to look at real estate syndications like you're going to take an airline flight across the ocean, transatlantic. You're flying from Houston, you're going to land in London, or you're going to sail across the ocean. Do you want to be with someone that's doing it the first time out, never flown an airplane, never done it, but they're going to figure it out? Or do you want to be with someone that's been doing it 10 years and is an expert? So we're going to look real hard at the experience of the team, and a great team will navigate through problems and they'll make a deal that's going poorly. They'll may have a good outcome. So that's probably the most important factor, is that team. A is the accounting. I wish I could have thought of a better way to say this, but it's really the numbers, the returns, the metrics, the underwriting. We do a deep dive on the numbers when we're talking about the accounting. And then L is the location. Very simple. It's the market, the submarket, the area risk. In markets, if you're talking about Houston, Dallas, San Antonio, or other parts of the country, all those have pockets of submarkets. So is like in Houston, is the Woodlands different than a property that's inside the Loop? It's totally different. So you need to understand the location, the market, the submarket, and all of those risks. So let's talk about the debt structure and those risks first. And this is the very first thing I look at. So the debt structure, you need to find out, is there preferred equity? Is there second liens or other types of what we call mezzanine debt? And you need to understand that risk. Ideally, it's a wonderful thing as a passive investor or a limited partner if you're right behind the senior debt, okay? If you're just second in line right behind the main lender. In today's world on big deals, that is not really realistic on most deals right now. Most of the sponsors are having to get preferred equity. They may have other sources of financing. There may be classes of shares that are stacked that are ahead of you, and they get paid first before you get paid. It doesn't mean you shouldn't do the deal. You just need to understand that how far down the line are you to get paid if something goes wrong. If you're right off the lender, perfect. These other types of things, you need to understand them. Also, does the business plan need a capital event in the first 5 years? Now, if you're getting 5-year fixed rate debt or longer, you don't need a capital event. Now, if you have a capital event, a sale or a refinance, that's fantastic. The key word in this sentence is need. Do you need a capital event? So find out if you need a capital event. Ask the sponsor, do we need a capital event in the next 5 years? If they got debt that's good for 3 years and it can be called, then you've got a problem there. You need to maybe not look at that deal. And never invest in a debt structure you don't understand. So you're going to need to understand debt structures. You're going to ask questions. And if you feel like you don't understand what's going on, or if the sponsor is not being real transparent about what the debt structure is, that's a hard no on the deal. So don't invest in something you don't understand. That also goes back to Warren Buffett. He never bought anything he didn't understand. The loan type and term, I like 5 to 10 year fixed rate debt. I prefer 7 or 10 if possible. 5 is the shortest runway I'll look at. So to look at, like using an airplane analogy, the shorter the term on the debt, the shorter the runway is and the less room for error you have. 5 years, okay. 7 years better, 10 years incredible. And you want fixed rate debt, agency, HUD, bank commercial loan, CMBS, anything like that, commercial mortgage-backed security, that's fine. If it's a loan assumption, and there's a lot of those out there with great interest rates, that's fantastic. Make sure there's a minimum of 5 years left on that loan. So once again, you have 5 years for the business plan. If the loan's due in 3 years, you may have a problem there. If something goes wrong, we don't know when the market's going to recover, what the economy is. Once again, you want that longer runway. And as far as money I invest in, or I'm going to raise money for, I'm going to participate in, I won't do bridge debt at all. So does it mean never invest in bridge debt? If you want to lose your own money, it's fine. I'm just a lot more careful, and I'm looking at the downside risk. Bridge debt can return better returns. Often the sponsor will show better returns. I just won't invest in it because I came in the business after 2022 and saw the amount of wreckage and bad deals that went bad. Everyone's telling us interest rates are going down, but we don't know where interest rates are going to go. So I just don't feel like, for most investors, the risk is worth it. Now, if you hit your financial goals and you have a very high net worth and you want to go play in some deals like this, or I just tell people, hey, if you want to take that kind of risk, go to Las Vegas. And that way, when you lose money, you'll have a lot more fun. So I just don't do bridge debt. I won't do it. And the more experienced long-term operators, most of them have gotten away from it, or they've been in deals that have gone bad or been very hairy and they just decided it isn't worth it anymore. Just say no on bridge debt right now, unless you have a very experienced investor. Cash flow or no go. I like Robert Kiyosaki a lot. And one of his things he says is, I'm a cash flow guy. If it doesn't cash flow, forget it. I want cash flow right away. So the main number I look at right away is I look at the DSCR, the debt service coverage ratio, which is the ratio of cash flow after the debt is paid. So if it's 1.25, it means we have we have 25% more cash flow than the mortgage, basically, or NOI. So higher is better, but the deal needs to cash flow day one. I look 1.4, 1.5. That's fantastic. 1.25 is a minimum, and it means the deal's cash flowing right away. If it doesn't cash flow, it's a no-go for me. I'm not going to invest in it. The best deals have cash flow now, and there's opportunities with increasing rents, increasing occupancy, doing other things to the property that we're going to increase the cash flow, but start with cash flow day one. If the deal's not cash flowing, what it means is it's a ticking time bomb that's eating away the reserves, and you're setting yourself up for more likely for a capital call if something goes wrong. Experience and expertise of the GP team. This is probably the most important factor I'm going to talk about. A really great experienced GP team will get the right kind of debt. They won't buy a bad location. They won't buy a bad deal. And they get better deals than the rest of us. Like a really experienced GP team is doing 10 years and they've got a track record of closing on big deals. They get the first look at everything. They will get a deal way before a lowly person like me will ever see it. So I want to get on the deals that these expert teams are getting and what they're looking at. You're betting on the jockey, not the horse. It's an overused term, but it is very, very, very correct. A great jockey will win a race. You're not betting on the property. You're betting on the operator. So what I look for in sponsors, I want 10-year experience full-time in multifamily, or very close to 10 years. I want at least one person on that team that's been there 10 years or more. If there's 2 or 3 people, or if they build a large team, that's even better. And the reason it's better is if something happens to that top person, there's other people on the team that are going to jump in. The size of the deal, a bigger is better. I want 100 units minimum on the deal. Ask anyone that's an experienced sponsor, is it easier to run a 250 unit property or a 50 unit property? And I think without fail, they will tell you it's easier to run a 250 unit property. Why is that? You've got 3 or 4 people in the office. You've got 2 or 3 maintenance people. If somebody calls in sick or has a problem and can't work or whatever, you don't miss them as much. On a 50 unit property, you've got probably one person running it and one person that's a maintenance person. Something happens to them, the property's not being properly cared for. So bigger is actually better, and larger deals in multifamily are definitely safer deals. I look at the full cycle exits of the operator, the past investment returns, which are not really the most important thing, but I do look at it. And I look at if they had bad exits. So I'm looking at their reputation. I look at any current issues they're having. Do they have distressed deals? If they have distressed deals, that's okay. Let's talk about it. Have they had bad exits? Have they lost money? Have they had capital calls? Okay. One key thing is when you're talking to people that were buying properties in 20, 21, or 22, and if they bought a lot of properties during that period, and if you ask them a question like, what problems are you having? What deals do you have that are distressed? What's going on with your portfolio? If they tell you everything is wonderful and everything's running like a top, you need to run. That's not realistic. Everybody's having trouble right now. If you ask about distressed deals and they're not being transparent about it, that's a big red flag. But if they're transparent about telling you what's going on and what's happening and how they're fixing it and they're making it through it, that's okay. I like to find out, are the GPs investing money in the deal and how much are they putting in? Are they putting their own money? I invest in every deal I raise money for. I'm the first person to put money in every deal. And if I'm not comfortable with putting my own money in a deal, obviously I'm not going to raise money for it. I also look at the size of the sponsor portfolio. Did they scale too fast? Are they, they go out and buy? I mean, I know of, sponsors that in 5 or 6 years, built $1 billion portfolio. Okay, that's amazing. It's incredible. But did they scale it too fast? I prefer people that are buying 2, 3, 4 deals a year, not a deal every month or every other month. So I do look at that. It doesn't mean it's bad if they bought a lot of deals, but it may mean they scaled a little bit too fast. But I like people that have bigger portfolios, but have done it slow and gradually. And then always diversify your investment in multiple sponsors, different deals, different markets. Don't put all your eggs in one basket. If you meet somebody and you love them, that's great. If they do well in your deals, that's great. But always diversify your deals. Try to expand your network. Look at other people, other deals, other markets. And on every deal you're going to invest in, always find out, why are the owners selling? There needs to be a story. We say in the business, no story, no deal. It's very, very, very true. We need to find out, why are they selling? Is the deal distressed? Did they have a loan coming due? Are they facing a foreclosure? So when deals are distressed from the owner, those are some of the best deals out there. But you need to find out, why are the owners selling? And if there's not a really good answer, this is not a great time for owners to be selling properties. There needs to be a story behind why they're selling the property. Okay, accounting, metrics, and underwriting. These are the numbers on the deals. And what I look for right now is an equity multiple of around 2 to 2.3 on a 5-year business plan. And so I want to do a double within 5 years. If it's not a double, it's probably not a good enough deal. If it gets above like a 2.3, I'm starting to be a little bit skeptical if they can achieve that, especially on a fixed rate debt. I like 5-year business plans. It's kind of the standard. If it's longer, that's fine too. But if it's shorter, realize that if a deal is distressed, they take time to turn around. 3 and 4 years is probably not realistic. IRR, I like 15 to 22% on a 5-year business plan. If it's lower than 15, it may not be a good enough return to invest in. If it's higher than 22, it may be a riskier deal, or the sponsors may be overestimating their abilities. It's very hard to do better than that right now. Hopefully, if they're overachieving on IRR, it means that they exited early, but you can't plan on that. Also, IRR is probably the easiest variable to manipulate as far as the metrics. So if you've got somebody being a little creative on the underwriting, they can change those numbers very, very easily. So look for a 15 to 22. If it's a little bit above that, that's okay on a 5-year business plan. If you're seeing an IRR above 25 right now on a 5-year business plan, I would be extremely skeptical on that, just based on the market. Average cash on cash, 6 to 9%. It's probably going to be more like in the 6 to 8% range right now. If you start getting around 9 or above, that's probably not realistic in the current market. And look at the pro forma rent growth. I like a maximum 3% rent growth in their numbers. If they're raising below market rents, that's going to take time. You don't just take over a property and raise the rents $200 or $300 a month right away and maintain occupancy. So realize it's going to take time. So look for 3% rent growth. If they're predicting more than that, I would be very skeptical. Watch out for large cuts in expenses in the first year in the pro forma. Can you cut expenses? Yes, there are efficiencies. Sometimes people can get a cut on the taxes because of the sale price of the property. Insurance is actually going down, but a good underwriter usually will underwrite the first year, no cut in expenses, and see if the deal works. And then those expense cuts are kind of icing on the cake that they can use to make the deal better. Is it a management or a construction value add? You want to avoid complexity. I like construction. I like management value adds over construction. I'm not a construction guy. Also, right now with the market, it's very difficult to do large construction projects. You've got tariffs. You've got labor issues right now with deportations and ICE. And so there's less people available to do the work. It is with the tariffs, it's very difficult to managed construction projects. So if you can find a management value add, it's under occupied, rents are below market, being managed poorly, or the management's given up, it's going to a foreclosure, that's a great deal. We want to look for positive leverage. So what I mean by positive leverage is the purchase cap rate higher than the loan rate. So if you're getting a 5% loan and you've got a 6% cap rate, that's 100 basis points or 1% positive leverage. Now, if you're going and getting a loan for 5% and you're buying a 4 cap, you got negative leverage there. That is not good. So look for positive leverage. On some A-class properties, it might be pretty close, but make sure the cap rate is not below the loan rate. You don't want negative leverage. There's takeover risk on every property. You do due diligence. You don't always find everything. I like when you're taking over a property from a reputable third-party manager that's been managing the property. If the owner is self-managing, there could be issues with fraud in the numbers. They can manipulate that a lot easier. I've had 2 properties that we've taken over that were self-managed, and we had problems on both of them with that. We had fraudulent tenants. We've had issues with some of the numbers. It's made the takeover a little shakier. It's not a requirement, but I like when the current management is a reputable third party, because a good property manager will not let the owner get away with anything that is fraudulent or is deceptive. Reserves, I liked the operators to have a minimum of 6 months of expenses in addition to their CapEx budget. So if their expenses are $50,000 a month, they want a minimum of $300,000, and that's in addition to all the money they're going to spend. More is better. You can't have too much reserve. So that's a good question. As how do you look at reserves? How do you look at reserves compared to your expenses? And then beware of unusually high returns in marketing materials. If someone's telling you they have a home run and they're going to return a 35 or 40% return, and it's a guaranteed huge high return, be very aware of that. Be suspicious of that. If it looks too good to be true, it's too good to be true. Basically, if it's a smaller deal and people are offering an unusually high return, then you might ask the sponsor, why are you sharing this? Why would you share this and syndicate when you could just go joint venture with some of your friends and make all this money? Why are you, it's like in the Godfather, why do I deserve this generosity? Why are you sharing this deal with all of us when it's so incredible? So be careful about that. If something looks too good to be true, if you have a bad feeling about it, it could be too good to be true, and maybe that's one to pass on. The last thing I look at is the location, the market, the area risk. You want to invest in markets with above average population growth, job growth, wage growth. I specialize in the Texas Triangle. So Houston, Dallas, San Antonio, all those areas have that above average. A lot of people moving here, a lot of population growth, job growth, wage growth. But if you're doing it in a different market, make sure it's an area that's really growing. You want to avoid smaller markets. So you want to avoid small towns or places that are really tiny. The exception to that is the expansion of a major market. So there's a lot of suburbs like in Houston or Dallas that were small towns, years ago, but Dallas is growing out. Like I would do like McKinney or Denison, someplace like that. In Houston, like Conroe. Conroe is a tiny town many, many years ago. It's booming now because it's an expansion of a major market. So if it's an expansion of a major market, that's okay. So know the submarket, the neighborhood, and avoid high crime areas. You want to look at places where the crime is not too bad. It's very hard to manage out of a high crime area. You want to know that submarket. You want to know that neighborhood. If someone says, hey, we've got a deal here in Houston, well, Houston's pretty big and pretty variable. So you need to understand that submarket. Does a sponsor live in that market? So I like the sponsors to be living in the market they operate in. Or is it a new market for the sponsors? So if the sponsors had a lot of luck in Houston and all of a sudden they're buying a deal in Atlanta or Charlotte or something like that, and it's their first time out, going into a new market has risk. So I would look for success in the market that they're investing in, that you're investing in, and be careful about that. Avoid flood zones and coastal properties. Obviously, you can buy flood insurance, but you want to be really careful. I would not invest in a flood zone. I would not invest in properties that say, hey, you can walk to the beach from here. If it's in Texas, you've got hurricanes and that could devastate the property. So I like on coastal properties, I look at how high above sea level the properties are. So when I drive a property, if it's closer to the coast, I'll get my phone out and look at how high the property is above sea level. And I want 50 feet above sea level, and that means no storm surge. They're still vulnerable to wind, but storm surge and flooding is what really devastates properties. If you get a lot of wind, you're probably just going to lose part of the roof, and insurance will cover that. Is there other natural disaster risk? So we look at here in Houston, obviously hurricanes, but you might have a place that has fires. The West Coast has earthquakes. There are different types of disaster risks. So know the area and what those disaster risks, or ask the sponsor. Also, you need to know the state landlord and tenant laws and the local eviction properties of the localities. So in Texas, it is very landlord friendly. A place like California is very tenant friendly, and it's very difficult for you to evict people. I don't like those type of markets, like say California. I think Washington State, Seattle is like that. New York, Chicago, New Jersey. It's very hard to evict people. So you need to know those policies in the state, and then look at the locality. Houston's a little bit slow on evictions compared to some other places because of the way the city and the locality work. So kind of know those local eviction policies. Do we want to evict people? No. We hate evicting people, but if they don't pay, they don't stay, and we have to. We need to know the laws and the policies. So be aware of that. And then look at new apartment construction, and are there barriers to development? This may not be as important if you're looking at like a B class or a C class property, but if you're running an A class property and they're building another A class property development across the street, and they're going to lease that up, and you're going to be competing against them, and they're going to be offering big incentives on the lease up, that could really hurt your property. So know the area. Some areas there's not a lot of development, or they don't want development, or they won't zone it or approve it. That can actually help your property because there's barriers. They don't want to develop the area. So figure out an area, what's the new apartment construction? Is there a lot of units being delivered? Right now, in a lot of the markets in Texas going out to 27, there's not a lot of new development going on. And so that's very favorable for Texas, for people that are buying existing projects. Okay, so the deal method, let's talk about how I eliminate properties very quickly. And I want people to master the art of elimination. So let's review real quick what the deal method is. Real quick, the DEAL, the debt structure, experience of the team, the accounting, the returns, and then the location. So the way I do a shortcut on this, and this is the opposite of almost everybody I know, I look at the debt structure, the experience of the team, and the location first. So on my initial screen, I don't even look at the numbers. The only number I look at is the initial DSCR. So that tells me is the deal cash flowing to begin with. I've got an elimination point there. Only after I've looked at, okay, I like the debt structure. I love this GP team. I like the location. It's in Houston, Dallas, San Antonio, wherever, and it's a great market. This looks really, really good. Then I start looking at the numbers. I think the biggest mistake investors make is they look at the numbers first. Wow, this is a great deal. I love these numbers. Let's start looking at the numbers. And they're not looking at the risk of the debt structure. They're not looking at the GP team, and they're not looking at a location. Is this a market I want to invest in? So by doing these other three first, I'm able to say no on deals in the first 5 minutes to 10 minutes normally. If I say a no, it's usually in the first 5 or 10 minutes. And then I only do a deep dive on the underwriting or the numbers if it passes my other screens and it's something I want to look at. So look at those first, look at the numbers last. Everyone wants to underwrite and look at the numbers first, but don't look at the numbers if it's a debt structure you can't handle, if you don't like the GP team, or if it's in a location or a market you don't want to invest in. So let's talk a little bit about my principal protection program. So I've developed this year, and this started as a challenge from my wife. So I'm going to tell the story a little bit on how this came about. We do raise money from friends and family as part of our investor group that we have. And my wife had a friend who's in a deal that's having trouble. And she was telling my wife about, hey, we've got this deal that's in trouble and we may not want to invest any more money right now. And my wife said, well, she asked me, how do we prevent this problem? What if a friend gives us money for an investment and we go lose their money and I lose my friend because we lost their money? And she said, I don't want that to ever happen. And so I was like, well, I mean, of course, I'm like, well, we can't ever guarantee that people are not going to lose money. That wouldn't be, even reasonable to think about that. And so my wife kind of looked at me and said, well, you're a smart guy, figure it out and figure out a way that people won't lose money. So that was a challenge. And I think there was kind of a connotation there that if I couldn't figure it out, I wasn't a smart guy. So that's a good way for my wife to challenge me. So I started thinking about it. I started looking at principal protection programs that I studied Wall Street products, first of all, because I knew that Wall Street had principal protection, like on bonds, you can buy protection that if the bond fails, you get protection against that. Kind of like The Big Short. That's what happened on The Big Short. Michael Burry did that. Or they have life insurance products that give you stock market returns based on the stock market. But if the stock market fails or crashes, you get a guaranteed 3 or 4%, whatever. So I studied those programs and I came out and I developed my own principal protection program that I offer. These are offered on my deals exclusively that I'm participating in. It's only people I work with, and it's separate from the investment. It's separate from the operator, and it's an optional program. You don't have to participate. I send the paperwork to people. If they don't like it, they just decline it. And it's something that you don't have to participate in. But if you're worried about losing money, this is an extra safeguard. So I'm going to tell you a little bit about it. So the program guarantees a return of 100% of the original investment, the principal amount, upon the sale of the property. And this includes a planned sale, a forced sale by the lender, or a foreclosure. So we're trying to guarantee people are going to preserve their principal. The protections based on capital reserves in an FDIC insured bank account. So we just put the money in an account and let it sit and see if it's needed. We're not investing the money. The program fee remains in the reserve account until the investment's made a total return of principal. So this could mean a sale of the property. It could mean that there was a refinance and they gave you your money back. It could be that they gave you distributions that equivalent to the amount of principal you originally invested. The fees in the bank account may also be used to pay the claims of other investors who purchased the principal protection program. So you're paying into a fund, and if another investor in one of my other deals loses money, we may take the money out to pay them. Now, that also means we may take their money that's put in the program to pay you. So it's a pool of money we're going to use to bail out people that participate in the program. The program doesn't guarantee investment results. The original investment principal will be returned with no interest payments. We're not guaranteeing a preferred return. We're just going to get your principal back. Any distributions from the project or partial payments to the principal from a sale or refi, they're subtracted from the principal payment amount that's owed. So if you got a distribution, say $10,000, and you took a haircut on the deal because of a forced sale and they paid you $20,000, you got $30,000 of your money from the operator. So I'm only going to make up the difference, which is the extra $20,000. So we're going to make you whole whatever you lost. You wouldn't lose your whole principal. The provider has the term of the original business plan to return the full principal payment to the investor if a sale or foreclosure occurs before the term of the investment. So on most deals, we have a 5-year term. We tell people the money's illiquid. The operator, let's say, is a foreclosure in year 2. We have 3 more years to give your money back. We told you the money was illiquid for 3 years. And this protects us just in case I've got a lot of deals that are going bad and I've got to scramble. If the project continues beyond the term of the original business plan, principal protection will continue, but no principal protection claims will be paid until the property is sold. Principal protection payment will be made only if the full principal has not been returned after the sale. This means if the deal goes out 7 years or whatever, we're going to extend it beyond the regular time. And we have 2 years after the sale to pay back any losses if they occur after the original term of the investment. And we're going to pay back losses as soon as possible. So if I have money in the account to pay people out, but if we have some kind of a catastrophe, the timing of the principal protection payments will be determined by the reserves in the bank account, and we'll use the full term of the contract if we need it. If I can pay people back immediately, I will. But if not, we're going to follow the term of the original investment or 2 years, whichever is greater. So fees and how they affect returns. I'm going to go through this really quickly. The program fee is 10% of the original investment amount. There's no other fees. Now, I've had some feedback. Wow, that sounds really expensive. But let's do a deep dive on those numbers. Most business plans are 5 years. So the fee is 2% per year on an annualized basis. You're paying us up front 2% per year, but I need the money up front because I need the money there if something goes bad in the first year or two. And I don't want to collect yearly payments on people or premiums or anything like that. So we collect the money up front. Interest earned in the reserve account can be withdrawn at any time by the provider. And the reason for that is I've got to pay taxes on the interest in the reserve account. I have an FDIC insured account that does pay interest on that. I can pull that out if I needed to pay the taxes on the reserve account. Investors need to understand that purchasing this protection will result in a lower return if the investment is successful. So let's go through that. Example, let's say a good exit. So let's use a typical syndication. Let's say you put $100,000 and we've got a 2 equity multiple over 5 years. Very, very typical investment. We have a normal exit that is $200,000 and you made $100,000 profit. Very typical deal. This would be a deal that went well. So normally you would make $100,000 profit. However, in the principal protection program, you put in $100,000, you paid a $10,000 fee, your exit's $200,000. So instead of your profit being $100,000, it would be $90,000 because you paid the fee. You don't get the money back. In this example of a typical exit, you would get 90% of the upside and you would still have the principal protection for the downside. So in a typical deal, you're still getting 90%. You're not getting everything. You had to pay that fee and it's non-refundable. So let's talk about a bad exit. Hopefully this never happens, but we have a $100,000 investment. We had $10,000 in distributions. You paid the fee. We had a forced sale in year 3 and we returned $50,000 to the investor because of the forced sale. So we would give all your money back, basically to make you whole, to make sure you had the whole $100,000. I think I left something out in there. The numbers don't quite match up, but we would return all of your money before the end of the year 5. So that's what a bad exit would look like. Principal protect. Oh, I didn't hit the other slide. Let me repeat this again. I'm going to go back for a second. So bad exit, $100,000 investment, $10K in distributions. You had a forced sale and they only gave you half your money back. So far you've gotten $10,000 in distributions, $50,000 in the forced sale. So that's $60,000 total. You invested $100,000. The principal protection program would give you the other $40,000 to make you whole. And we do that by year 5. So that's the way it would work on a bad exit. Key points for investors, focus on not losing money. So value consistent returns over chasing home runs. Don't try to get rich quick. Try to get rich quick. It doesn't work. Try to get rich for sure. Somebody told me one time, the faster you try to get rich, the longer it takes. I really believe that. So don't try to get rich quick. Value very consistent returns. Develop your own investment criteria and your own principles I'm showing you what mine are today. So go out and figure out what works for you. Develop your own list, your own criteria, your own principles. If you want to adopt mine, I think they'll serve you very, very well. And then look at as many deals as possible. So the whole idea of the deal method, especially the shortcut, the DEL, and look at that first, is to say no quickly. Say no quickly on these deals. Try to increase your deal flow. Talk to a lot of sponsors. Look at a bunch of deals. Say no quickly, and then maybe you do a deeper dive on a deal that looks like a yes and really research it. Focus your time and energy on deals that fit your criteria. So we want to focus on deals that fit our criteria and spend your time on those. Don't underwrite every single deal you look at. Look at deals that don't fit your criteria, eliminate them, and then go and focus the time and energy on good deals. And then finally, put your goals in writing and take action. So 2026 is almost here. The most important thing that you can do is to put your goals in writing, figure out how many deals you want to do next year, and take action on great deals. particularly in the apartment markets, I think 2026 is going to be the last end of an opportunity to get really at the bottom. And if you want to buy low and sell high, 2026 is going to be that year. So put your goals in writing and take action and fulfill all your goals. I think it's a really good method to look at. I'm really proud of the Principal Protection Program, and I think it gives people an added thing that if they're really worried about investing and they want to buy into something, it's going to give them some downside protection, and they're more worried about downside. I think it's appropriate. It's not for everybody. It's an optional program. And, if you want to participate, that's great. But if it isn't for you and you're going for maximum returns, just decline it and we're good to go. I'm fine either way with people. I don't push it on people. It's something we offer, but it's not something that's necessary to get in our deals.